The file was never supposed to see daylight. Yet here it is, unsealed, digital, dissected. Pages stamped with names, timestamps, and transactions so specific they almost whisper. It's not the names that matter most, it's the money trail. And if you read between the black bars, it quietly predicts something no one's prepared for, a new kind of market risk in 2026. One that doesn't come from inflation, or China, or AI, but from reputational collapse. Let's slow down. Because the story you're about to hear isn't about scandal. It's about how the financial world hides disruption, until it's too late to hedge against it. Why this matters now, early January 2026, the Epstein Files finally reach the public archive. Over 900 pages, dozens of influential figures. A decade-long pattern of private credit movements, trust funds, and offshore shells. News networks rush to find the gossip. Traders, however, scan the appendices, the bank names, the foundations, the investment vehicles. Because in a global economy addicted to perception, reputation is liquidity. When that perception breaks, asset values don't slide. They vanish. Short pause. And right now, the files hint at something the market refuses to price in. Reputational contagion risk. How the system actually works. Imagine you're running a large family office. Billions under management. Some of it in stocks. Some through private funds. Some through carefully structured vehicles buried in islands you've never visited. Your biggest goal isn't growth. It's invisibility. Because wealth at that level behaves like a shadow, valuable only as long as it stays out of direct light. Then, suddenly, a public document names one of those entities you've used. Not accusing, just mentioning. The compliance department freezes your trades. Counterparties pause lending. Liquidity evaporates not because of loss, but because of fear. That's reputational contagion, and it doesn't wait for evidence. It spreads faster than any virus on a Bloomberg terminal. The hidden timeline. The first tremor already appeared. Late 2025, a quiet shift in private credit spreads. Unexplained widening around a few boutique funds tied to luxury real estate and offshore philanthropy. Days after, short-term repo rates kinked upward. Nothing major, a rounding error. But the pattern mirrors what happened before Lehman in 2008 and Archegos in 2021, a sudden break in trust disguised as a technical glitch. Fast forward to now, 2026. The files drop, and within hours, some institutional accounts start reallocating. Not because of what's proven, but because nobody wants to be the last name standing next to uncertainty. The uncomfortable math. The modern financial system is built on reputation multiplied by exposure. That formula looks simple. Confidence, X leverage, S stability. Lose confidence, the multiplier collapses. According to BIS data, about $23 trillion of global assets sit in private markets. Opaque, interlinked, reputation sensitive. If even 2% of that base goes defensive, roughly $500 billion could flee into safe assets. The domino effect distorts yields, triggers margin calls, and suddenly, the risk-free bond doesn't look so risk-free anymore. That's the hidden math behind the headlines. The real Epstein effect might not be political. It's probabilistic. Contrast hype versus reality. The mainstream chatter is fixated on names, scandals, morality. But traders know markets don't fall because of what people did. They fall because of what people believe about what people did. We've seen this movie before, from Enron's accounting smoke to FTX's overnight collapse. Each time, investors said, it's isolated. Each time, they were half right, until correlations forgot to stay quiet. The risk lurking beneath this story isn't that a few elites are exposed. It's that faith in the opacity of private wealth is breaking, and that opacity is the lubricant that keeps the machine from seizing. So what does this signal about 2026? Markets are pricing a soft landing, AI-driven productivity, and a gentle Fed. But reputational damage doesn't knock. It implodes overnight. The next shock may not come from a bank failing. It might come from a fund refusing to confirm its exposure. A liquidity black hole forming, not from losses, but from silence. A hint of irony. Funny how the most dangerous thing in finance isn't fraud. It's embarrassment. Quick question for you. If markets are built on trust, and trust is breaking in private, how would you spot the next domino before it falls? I'd love to see your take in the comments, especially if you work in audit, compliance, or trading. And if you're the type who wants to understand what the numbers don't say, maybe stick around. The next deep dive is going to connect this risk to election year capital flows. And trust me, you'll want context before the headlines hit. Escalating stakes. Because here's the irony. Every system built on secrecy eventually becomes addicted to exposure. The Epstein documents aren't the end of a case. They're a beginning of transparency shock. Watch what happens when corporate boards quietly start vetting donation and endowment structures. Watch how fast asset management divisions draft social counterparty risk frameworks under ESG labels. They'll say it's ethics. It's actually liability control. Reputation now prices like an option. Volatile, leveraged, and impossible to hedge. The bigger picture. This isn't about gossip. This is about how dirty data contaminates clean systems. Once you realize wealth management is just a trust network, every exposure chart starts to look biological. Nodes, contagion, latency. What we're seeing in 2026 is a subtle correction in reality, not in price, in confidence. And confidence, once cracked, doesn't bounce. It decays. The next wave won't scream crash. It'll whisper pause. A meeting canceled, a trade delayed, a deal under review. That's how systemic risk actually begins, not with a bang, but with a calendar conflict. Final reflection. Somewhere in those declassified pages between signatures and settlements, you can trace a truth about markets. Money isn't backed by assets. It's backed by belief, and belief is the most fragile currency we own. The Epstein Files aren't predicting a crash. They're diagnosing a symptom. Reputation has entered the pricing model. The question is, what happens when markets start discounting secrets? See you soon. Don't forget to subscribe.